Welcome. Thanks for joining us. I have had the good fortune. I started my career as an electrical engineer on a nuclear power station in England. And then I moved into computers, initially mini computers, and then into microcomputer software, and moved to the US, to California. And I've had the good fortune to play a key role in building six prior high-tech startup companies, two liquid outcomes, two of which were IPOs to the NASDAQ. One of those was Ashton Tate, which dates me. That was a database company. We made a product called DBase, DBase 2, DBase 3, DBase 3 Plus. And then I went on to Symantec, where I was the 12th employee at Ashton Tate making DBase. We went public later, and then at Symantec, I was the executive VP there, responsible for large chunks of the business. And then when we started buying companies, I ran the largest acquisitions. My team launched an Norton antivirus, and we went public also on the NASDAQ. I launched a I launched Manhattan Street Capital because of Reg A Plus. To me, it's a very well written regulation. I see a lot of opportunity for it. It's continuing to grow and gain traction. There's more and more innovation around it, which when I get into the series offerings topic in a moment, you'll see. Um, so what Manhattan Street Capital does is we do primarily two things. We advise companies that work with us to by bringing in the right service providers of all types, and then advising them to optimize how they make their Reg A pluses work and the marketing of them. We have an investor membership that are interested and engage in those companies. And we also have a website platform. You can see a picture of our homepage behind me. So we host offerings, not just Reg A Plus, but primarily Reg A Plus offerings on our website to maximize the ease with which investors can invest and with which, and also the efficiency of marketing, so that we can reduce the cost of marketing for our client companies. So we do those two things. I launched the company in March, almost 8 years ago, in March of 2015, because of Reg A Plus. I'm not an attorney, we're not valuation professionals, we're not underwriters or broker dealers. So please take everything I say with a pinch of salt. I'm trying to convey to you, inform you about everything I say here. But I am not claiming to be, and I'm absolutely not any of those other things that I just disclaimed. At the end of the session, I'll answer questions. So you're welcome to put them in the chat box, and I'll answer them as best I can later on. I suggest you use speaker view, or it may be that the view that I've set up this time may end up being better enough. We just let a couple people in. Yeah, if you're seeing me front and center, then leave the view the way it is. If you're not, select speaker view. That will improve it. We're recording this webinar, and we will make a version of it in a blog post on Manhattan Street Capital with a clickable contents list, so you can easily go and look at the parts of the video you want to see later on. So the agenda is, I'll touch on what is Reg A Plus, what are its advantages, what is a series Reg A Plus offering, I'll explain that, and what it's good for, what are good uses for a series Reg A Plus, because it has a bunch of neat things you could do with it that weren't possible before. And I'll also talk to the subject of when somebody's posted a funny question. Yeah, but I'll also talk to the question of aftermarket listing of ownership, of units of ownership or shares of ownership in companies that are using series offerings. That's a unique listing phenomenon. I'll talk about liquidity in Reg A Plus for insiders as well as for investors, how to market the Reg A Plus briefly, how to involve friends in a series offering. It's a particular special case. I'll talk to the schedule for a typical Reg A Plus as well as the typical costs. And then I'll get into some tips and techniques, assuming there's time for that. And then I'll get into the Q&A. Again, my name is Rod Turner, Manhattan Street Capital, and welcome. Thanks for joining us. So now I'm going to go, I'll explain a summary of what Reg A Plus is. So Reg A Plus came into effect in the summer of 2015. It enables people of any wealth level to buy securities in offerings made online. And they can actually, as far as the SEC is concerned, those investors can come from anywhere in the world, except problem states like Iran or, North Korea, that kind of thing. They don't have to be wealthy to invest. A typical Reg A Plus minimum investment amount, the lowest I've seen is $100, but typically $300, $400 is the minimum investment amount that companies establish. So it's democratic access to great opportunities that non-wealthy people didn't have before. It's a kind of public offering. It's limited to US and Canadian headquartered companies. Worldwide companies can use Reg A Plus, but they have to be doing something legitimate in the US, and the entity doing the offering must be a US entity. Marketing and advertising is acceptable. In fact, it's an absolute requirement in order to raise money online. And Reg A Plus was designed from the outset to facilitate raising money online on the internet. So marketing is a key part of it, advertising especially. And one of the side benefits of doing a Reg A Plus is that because the SEC qualifies each company that is allowed to conduct a Reg A Plus, that credibility goes a long way. It causes strategic partners to come along. It causes institutional investors these days to participate in many Reg A Pluses. So, the awareness level, courtesy of COVID and people being stuck at home for such a long time, that caused online investing, crowd investing, Reg A Plus to accelerate its growth. Probably 4 or 5 billion a year being raised in Reg A Plus right now. And to put that in context, all private placements in the US collectively raise about $1 billion a year. So Reg A Plus has passed that milestone. About 120 companies qualify their Reg A Plus per quarter, and that number has been growing nicely. Each Reg A Plus offering, it's automatically a year duration, and you can actually set it up so that it's a 3-year duration. You can terminate it early, you can terminate it whenever you want to. But that versatility is very nice. So you don't have to shut it down. If you want smooth continuity in raising money, you can do that. And you can change the share price as you go too, which of course is one thing you'd want to do over a 3-year period. Each Reg A Plus requires a filing with the SEC as well as audit that goes back a short period if the company's only existed a short period, but if it's existed more than 2 years, then the company has to provide a US GAAP audit for those 2 years. So Reg A Plus has gradually, in the early years, gradually built and become now a significant factor with a lot of innovative things happening around it because it's facilitating offerings that you couldn't do before, which I'm going to get into with the series offerings discussion. Advantages of Reg A Plus. It's less expensive to do than other things like an S1 IPO, and it's more versatile. There's a lot of new things that you can do that weren't possible before. It costs a lot less than a full bore S1 IPO costs. The fact it's the opposite of a regular IPO where you have a quiet period and you can't do anything in the way of marketing that's unusual. It's the opposite. You are required to market your company to raise money successfully, via the expected means, especially social media advertising. It's faster and simpler. I'll get into the schedule later, but the SEC journey is a lot simpler. So in comparison to a S1 IPO filing with the SEC, a Reg A Plus is probably 10 or 15% of the workload, and it happens a lot faster. I mentioned that you can change the share price and the valuation of your company as you go, and you are allowed to I'll look at the questions later. You are allowed to um, set a low minimum or a zero minimum raise. So you can draw down investment money from escrow and issue the shares to the investors on an ongoing basis. And if you set up the Reg A Plus properly, you're allowed to use the proceeds of the raise to continue to promote the raise. So that makes it much more efficient. Having a high minimum only makes sense if you're buying an asset and that's the purpose of the raise. If you're buying a building for $12 million, then you probably need an escrow at $12 million, and it's going to be expensive because you have to shell out all the money to reach that 12 million before you bring in $1. So it's better to have a low minimum. It's one of the lovely things about online raising is that a lot of the investors become brand ambassadors. They become fans of your company. If they already are fans, then that's so much better again, right? Because they have a high propensity to invest. And you're getting better valuation than you would get in a Reg D or an angel or a venture investment. And you're providing liquidity to the investors at one level or another, depending on the approach you choose. And you maintain control of your company when, in comparison to a venture capital investment, you don't put yourself at risk of being booted from your own company. There are many other advantages, but that's a good summary of them. So I'm going to talk a lot about Series Reg A Plus offerings because that's it's opening and has opened up a raft of very interesting ways to raise money, especially for people and companies that have a fan base, customer base of scale. So now I'll describe what a Series Reg A Plus is. It's usually an LLC is used. An LLC structure is the preferred structure. It lends itself to this, and you can have one or two or six or 20 or 30 sub offerings within it. Each of those is its own mini subsidiary, another LLC, but it's really simple to set up, and it's selling shares or units of ownership in something. So you could do if it, one of the, for example, if you were doing real estate, you could do 20 different structures, 20 different buildings, and each of them has its own terms. The terms are unique to each building. So that makes it easier to market the offering. And it gives you a lot of versatility because you can add more series as you go. You can start out with one or two or three and then add more as you go. That flexibility is very impressive. So these subsidiaries, these little LLCs, are very simple to set up, and the way in which the primary parent LLC is set up is designed to facilitate that. So it becomes a very flexible way to raise money. And then the question is, well, where does it suit? What does it help work best with? It works really easily with real estate. Real estate has been more than 65% of the capital raised in Reg A Plus to date has been for real estate offerings for all sorts of good reasons. But series offerings are nice because literally you can raise money for one purchase at a time or multiple purchases at a time if you choose to. That flexibility is nice of being able to, because people are more motivated oftentimes by a particular specific opportunity than they are by a general opportunity. So it can make marketing a lot less expensive. You can use a series offering for collectibles, where for things, there's a whole raft of things that you can raise money for. So you can put art, collectible art for sale in a series offering. And you can therefore sell fractional ownership to it. You can sell 20%, 60, 80, 100% of it that way. And then later facilitate the owners selling their purchased units or shares of security in that unit offering. So going through the list, actually, I'm spending too long on one or two of them. So alternative assets as a class, there's a lot of interesting things that individuals that aren't really, really wealthy would like to invest in, but they weren't able to. You can't invest in a $250,000 used Ferrari if you don't have 250K. But if it's a collectible and you're able to buy units in it for $10 per, you can decide how many you want and become an investor in an appreciating asset. And of course, with the fluctuations in the stock market, people are a little bit more interested in more stable returns and uncorrelated returns. Music lends itself well. The SEC, as for real estate and music, the SEC gives more flexibility to making offerings. So you can set up a system to buy the rights of music rights of various musicians, any number of them within reason, in a series offering. Artworks I mentioned, jewelry, collectible cards, collectible watches, collectible vintage cars. Those are some of the things that people are using or can use Reg A Plus series offering for, and they are using, actually, not just a hypothetical. That's being done as we speak. So we are democratizing access to expensive items that can be very attractive investments, that could be a good diversification strategy. And of course, when we're doing that, then those items themselves are attractive, have a following, and are interesting, and that makes the marketing expense lower in the series offering when it's offering things that people are interested in, which, of course, those things are all examples of. But you can do it. You can use a Reg A series offering for other things beyond stuff. Things that like the ones I just listed. So it suits social media influencers and athletes and sports teams and established brands that have built sizable presence, because you are able to. It has to be done in the right way. There's a little bit more complexity from a legal setup standpoint than there is when you're just selling fractional ownership of things. But for example, social media influencer might be doing exceptionally great now and kind of burned out from all the work that he or she is doing, and then want to sell a slice of their future income through a Reg A Plus offering or a Reg A Plus series offering in order to in order to diversify and de-risk their life and maybe professionalize their business. So that's an example. Athletes can do the same thing. Sports teams can do it, and it's more obvious with brands. Companies that have a successful brand following, that it's obviously the case that they're going to be able to reach out to their fan base and to raise money more easily. Um, it's funny. I'm seeing some questions come in. I'll look at them later. It'll be fun to get to them. So, and the versatility to do more than one offering within an offering. So, Reg A Plus is capped at $75 million a year. So the parent LLC entity is limited to $75 million maximum per year. But again, you can do sequential years. However, establishing that maximum and going forward with your Reg A Plus series offering, you can have just a couple of relatively humble starting points of things that you're selling, and then step it up as you go. So that flexibility is also nice. The democratic access to attractive investments that Reg A Plus brings is a very attractive component, and series offerings in particular. Some examples of companies that are doing or have made Reg A Plus series offerings: Commonwealth for racehorses. So you're buying an ownership slice in a particular racehorse. For music, royalty traders. For real estate, there are a few, but Arc 7 Properties is one. Diamonds, there's a company called Luxus Argyle that does that. And then there's a company called Collectibles that does trading cards, collector's cards, collector's art, collector's comics, and collector's watches. Um, and there's one that specializes in rally road. So there's a variety of things, but includes vintage cars. So I'm giving you a sense of why a series offering can be an attractive thing there. Of course, you may want to be able. So what you see happening in series offerings is, in some cases, let me check the time, how we're doing. Okay. In some cases, um, the idea is that people are buying fractional ownership in something, and they're told that in 8 years' time is when there'll be a liquidation event. We'll sell this asset at that point. In other cases, the the companies conducting these offerings are intending to provide an option for their buyers, their investors, to sell their securities easily online. Reg A Plus provides that. As far as the SEC is concerned, any Reg A Plus investor is allowed to sell their security immediately, unless the company locks them up from doing so. And of course, the company isn't required to make that liquidity easy, but it's an advantage to do so. So the point here is that there are two attractive methods for the people who have invested in the sub-series in a Reg A Plus that have one or other assets that they bought into. The two places that are really appealing to list those securities or those, yes, securities are alternative trading systems and things called ATS. One of our webinars talks in great detail about what ATSs do and how they work. And another one is a bulletin board. That's a phrase that the SEC has a specific definition of. And I think, frankly, that the bulletin board approach is probably the most appealing because it's simpler. It has a lot fewer regulatory hindrances attached to it, but you aren't allowed to make money on those transactions. So a bulletin board is a simple way that people who would like to buy and other people who would like to sell the securities that you have brought to market are able to meet and execute a trade. They're not being they're not paying you a fee, they're not paying you a commission on that. So there's more detail behind that, of course. But to me, I think a bulletin board offers a great deal of promise as the aftermarket exchange vehicle for Reg A Plus series offerings. So now I'm going to touch on general Reg A Plus liquidity because it's one of the powerful things about Reg A Plus. Every Reg A Plus is, as far as the SEC is concerned, it's a public offering. It's not automatically an initial public offering. You can use Reg A Plus to list on the NASDAQ or the NYSE. And you can use Reg A Plus to do a direct listing on those exchanges too, in the right circumstances, when everything's set up properly, when you've accomplished the right things. But you don't have to do that. You don't have to list anywhere. You are allowed to. So in theory, somebody who invested $1,000 today or yesterday in your company, if you issue them the shares right away, it might be a week or two delay in getting them their share certificates. Their shares are typically held at a transfer agent. They're allowed to sell those shares. So liquidity is a really good thing about Reg A Plus. Then it comes to where would you list? You can list, as I said, NASDAQ, NYSE in the right circumstances. You can list on the OTC QB or the QX. If you go to there is a post-offering reporting obligation in Reg A Plus where once a year you must produce a US GAAP audit, and every 6 months you must produce management financials for your company. And if there are material events, they must be reported within 48 hours. So my point is that for companies to go, if you use a Reg A Plus to list on the NASDAQ or the NYSE, then you need PCAOB audits from 1 quarter prior to that listing and thereafter once every quarter. So that's an expensive escapade. But if you go to the OTC QB or QX, you're still just doing one annual US GAAP audit. So that's a very much reduced burden and expense. And you are required to keep that annual audit going forward after having done your Reg A Plus, obviously. So one of the advantages of Reg A Plus offerings at the parent company level is that you are allowed, as the owners of the company or your existing investors are allowed to be selling insiders in a Reg A Plus. So up to 30% of the capital that you raise, a maximum of 30%, can be selling insiders, be they founders or investors. So that's a nice flexibility. And the fact is that conducting a Reg A Plus, unless you as the company CEO prevent this, unless you put in a lock, the Reg A Plus unlocks all of your investors that have owned their stock for more than a year once they've exceeded their Rule 144 holding period. So you may be raising money in an offering with this particular security here, but all of your investors are made liquid, which isn't to say that it's easy because you haven't listed their security, but you could provide a conversion from the security they own into the one that's listed, as an example. And of course, if you go public to the major exchanges, then all of the preferred ABC class of investors, all of them convert over. So insider selling is is allowed in a Reg A Plus in a post during the Reg A Plus and afterwards. There's more detail to that. We have a FAQ on that on the MSC site, and we have a whole webinar about liquidity in Reg A Plus as well. You can search the top right box, search box on the MSC site will get you that content. I said you don't have to list your company by doing a Reg A Plus. There are some limited ways of providing direct liquidity to investors if you choose to. I don't find them to be terribly attractive, but they do exist. The main entity listing options, I said, don't list anywhere. You can list on an ATC, the alternative trading system, on the OTC, the NASDAQ, or a direct listing. One of the nice things about it's not an ATC, it's an ATS. One of the nice things about an alternative trading system is that they don't have shorts and they don't have naked shorts. A lot of companies' share price gets decimated. A lot of companies' share price gets decimated by naked shorts from broker dealers that are allowed to do that. So you're vulnerable to that on the NASDAQ, on the NYSE, or on the OTC markets. You are not vulnerable to that on an ATS. So an ATS is a simpler opportunity for listing. For that reason, it's very attractive. So now I'm going to move over to how to market your Reg A Plus, especially in the context of a series offering, but not exclusively that. So one thing to know is that most of the Main Street investors who engage and that are entertained by that choose to invest in a Reg A Plus are optimists. It's a completely different thing than institutional investors and many accredited investors. Wealthy investors tend to have so many options before them, they tend to be more skeptical, which is fair enough. So to give you an idea of what I mean, we've had days where advertising outreach in social media drew in investors to a particular offering that was put together well. And they looked at the offering page and they liked it enough that they clicked the Invest Now button, which we have on our site, of course. And we asked them for their email and their phone number. They provided that information and then went on. Of the people who clicked the button and gave us that information, we've had days where 70%, 70% invested on their first visit. So, when that happens, we're dealing with optimists, right? We are dealing with optimists. And I see a lot of that because I monitor the email traffic going to our companies, our client companies, CEOs, and their other team members to make sure that they know how to answer those questions and make sure that they are answering the questions that come in. They're not that many, but I pay attention to it. And it's amazing to see how optimistic some of these folks are. So a company that never talked about doing an IPO anywhere, never mentioned it, never hinted at it. Jim, who invested 3 months ago, will fire off an email to the CEO asking him, when's the IPO? So that's an optimist. So just know that because it makes a very big difference as to what kinds of offerings can succeed in a low-cost marketing way. Main Street investors, 60%, 70% of the investments are made on a smartphone, Apple obviously and Android, on a tablet and a PC as well, one or other of the computers, but mobile phone is the dominant. 55% of investments are made via debit credit cards, and ACH is another 40%, and the rest is checks and wires. And institutions do invest these days in Reg A Plus. That is new in the last 2 years. Continuing on how to market. If you have an established brand or if you are a social media influencer, if you have a lot of followers, then the cost of outreach to your followers and fans is drastically lower, which can make a Reg A Plus offering an extremely cost-effective way to raise money. That's one of the reasons I chose to put this Reg A Plus webinar together, is because it's so cost-effective when all you have is the legal filing and the audit and some other miscellaneous fees, but you're not spending megabucks to bring in every investor because you've got a large fan base, so you can bring them in with your own communications. So that's a fantastic thing. I think the lowest cost Reg A Plus that we've done so far, we're helping a client, was a biotech company where their total cost of capital was 6.5%, but that included all of their advertising expense, all their expenses for their Reg A plus. So very exciting delivery in that case. But if they had been dealing with fans, that could have come down to 2.5%. Could easily have been a 2.5% total cost of raise. I mentioned social media advertising is the most effective outreach vehicle to people who don't already know your company. That when we need to do that, that's the most effective vehicle. The ads have to have a clickable link in them so that the investor can see what the terms of the offering are, what the offering circular, which is what it's called when the offering is qualified. The SEC uses the term offering circular with all the details and the audit numbers in them and so forth. And the SEC's restrictions on the kind of advertising you can do are mostly reasonable. Nothing terribly unexpected there. You can't use hype, for example. You can't introduce a new product and say it's going to replace everyone else. We're revolutionizing the market. That's too grand a claim. An advantage of a series offering is that having pinpoint precision, this is the building we're offering, this is the vintage car we're offering, this is the racehorse we're offering, it's much more motivating. It's much easier to get investors. When they're narrowing in on something they really like. So that makes for lower cost marketing itself. And of course, in the case of many alternative investments like jewelry and art, select art and select jewelry, and select vintage cars, they're appreciating assets with a very strong track record. So the track record speaks for itself, and that makes it much easier to market the offering and raise money because people can see, oh, if I buy this diamond and this quality, I can see what the benchmarks have done for diamonds of this quality. So that makes it less expensive to market. The nature of being a series of separate little offerings are much smaller, so they run out of capacity quickly. That makes it easier to raise money. And the fact that a lot of them are attractive investments that already have a following, so playing cards, trading cards, vintage cards for that matter, they already have a following. So it makes it much easier to market the raise. Having an app helps. These days, having an app is a good thing for this type of raise, for communication, better communication with the investors and engagement of them, because that engagement is such a valuable thing. If you do a series offering, you can involve friends or business associates where you work out a deal with them and they make a similar offering within the umbrella of your parent LLC entity. So that's a nice thing to know. We have a customer now that is working on bringing her company through a Reg A plus and raising money through it, obviously. And she writes books and does movies of her books, and she's got a lot of great fame and reputation and success. And she is considering inviting influencers and other successful people in her field to join her and do a series offering because it makes sense, right? Okay. Now, let me check the schedule. Okay, we're good. If you have a complex company with a messy financials that go back 2 years or more, then it's going to be expensive to get the audit done and it's going to take a lot of time. So that isn't fun, but that's life. And you cannot make the filing of your Reg A Plus without the audit being included. However, there are quite a lot of these companies that are doing series offerings that I was mentioning earlier. Quite a lot of those were pure startups at the beginning. So if they had an audit, it was for 6 weeks since they set up the entity. So it's extremely simple, low cost audit, which doesn't take a lot of time. So, that is what it is. The complexity can be there if the financials are a mess. So actually, I want to hit on a couple of important points that I missed there on the schedule front. So in a situation where the audit isn't going to be a problem from a time standpoint, then typically it takes 2 months for the company to prepare their content for submission to the SEC with the help of the securities attorney, with the help of my team when we're involved. So about 2 months to prepare. It can take longer. You know, if the team gets distracted by a major business event, then it'll take longer. But with sufficient attention, 2 months to get the documents prepared to file with the SEC is reasonable, and 2 months to get qualified by the SEC is reasonable. And we've had 3 or 4 of our client companies who were qualified in a week or two from when they filed. The SEC says, make your filing and have it be complete, and we'll get back to you in a month with our comments. And if they could decide that there aren't any comments, but if there are comments, then the company needs to respond at that point, and then they give themselves another month. So 60 days is commonplace as a metric to use for how long it'll take to get through the SEC. But again, the SEC seems to like Reg A plus filings, and when there are known service providers involved and they're uncontroversial in their terms, then getting qualified by the SEC unusually quickly does happen enough to be aware of that and to build that into your thinking. So that's the schedule stuff. And then you have a year, automatically your Reg A Plus is qualified for a year, and you can set it up such that it can run for 3 years, and you can terminate it when you're ready. Costs. So real estate offerings are a little more expensive from a securities attorney point of view. But if we assume a simple audit, which is what I'm doing right now, I'm assuming a simple audit because I can't figure out for you what your custom audit would be. If you've got messy financials that aren't complete, that could be a lot more expensive. But with a simple audit, then to spend about $150,000 in all inclusive expenses to get to the point that you're qualified is a reasonable number. It wouldn't get much lower than that. And it could get higher than that if you delayed and so forth. But 150K is a reasonable budget to go in with. And then when we are live raising money, the sequence of events, it does vary according, you know. So if we're talking, if a company has a large fan base, then when we're ready, marketing that to that fan base is going to cause rapid action. So companies with large customer bases can rapidly raise money. We've had that happen. But when it's a company without a large fan base, without a large customer base that's starting out, then you aren't going to spend much money in the first month of advertising because we don't really know yet which target audiences, which ad creative are going to work the best. So if you spend $5,000 or $10,000 in advertising in month one, that's enough to test and evaluate and tune and optimize. And from that point, you go on improving and optimizing the marketing till you reach a stage that you're happy with it, and then you expand the spending on that outreach marketing. And obviously, sending emails to our member base is a good thing to do, but that goes without saying. Okay, so let me touch on the expenses then. Once we have achieved efficiency in that marketing outreach for a company that doesn't have, or an offering that doesn't have a large amount of traction already, doesn't have a big fan base, then, the advertising cost, the best that I've seen so far was $3.30 spent per $100 raised. But that was for a biotech company. That was before Apple started imposing limitations and restrictions on marketing efficiency on Apple devices. So that number is no longer precisely relevant, but that's the best that we've seen directly. But once you get it working properly, to achieve a 6 or 8 or 10% marketing spend level for the money that's brought in from fresh investors is a reasonable expectation. And you have to, as a cost, you have to do management financials once every 6 months and an annual US GAAP audit if you don't list on a major exchange. So that isn't the worst. I mean, a US GAAP audit is relatively straightforward, but it is an expense. So leveraging the fan base, leveraging the brand, leveraging customers is intensely valuable. When a company has an active website with a lot of activity on it, then that becomes a very effective, very, very cost-effective place to promote their investment offering. So we have customers that are doing that, and that's working very, very well for them, as you would think, to bring down the cost of marketing. Okay, so now I'm going to move on to tips for success. Excuse me. Some of these things may be very obvious to you, but pardon me, I don't know the level of knowledge that you guys have in the audience today. So one is there's a thing called test the waters. I actually suggested this in June of 2012 to the SEC that they allow entrepreneurs, CEOs to test market their company to see if it would be cost effective to promote in a raise situation without having an audit, without having an SEC filing, to make life simple. So that's called test the waters. We've trademarked that term in a number of interesting ways because we were there, we were paying attention. But the point is that you can cost effectively test market your company in order to see how it would fly. You can't raise money from that. You could take reservations that are non-binding, and later when you do the raise, re-engage with those people to invite them to invest. But when you're doing the test, of course, you can't actually raise money from that. There's two tiers of Reg A plus, tier one and tier two. It's almost always a bad idea to use tier one, so I'm not going to spend time on that. And we have a FAQ on the MSC site that goes into detail about why tier one isn't very useful for most companies. Avoid email lists. Of course, there will always be an exception in life, and we have one customer right now where their agency is taking an unusually different approach to emailing to a large list and having some success. And this is actually the first time that I've seen that in almost 8 years since I launched this company, Manhattan Street Capital. So in general, when you rent lists and buy lists of prospective investors, it all sounds great until you do the work, until you send the emails, and then nothing much happens. Uh, Email service providers have become more and more restrictive. Apple is inserting themselves into email delivery on Apple devices as well. But basically, I've just seen so many tests and so much wasted money and time. So in general, be very skeptical about the value of renting, buying a list. There are special cases, like our member base is a special case because we're dealing with them regularly and they're already investors and they understand the context. But in general, lists aren't very valuable. Include international because the SEC allows that. And as long as we have the payment methods in place, credit and debit card being the primary ones for international investors to engage, then that could be super because there's a lot of people in the world that are starved of great investment opportunities and would love to own equity in a US company or in a series offering in a piece of art or in a car or collectible watch. So international can be a very profitable place to market to. You're not limited to the US. So don't ignore the rest of the world. Avoid big auditors because they can't charge too much and tend to be so slow, sometimes remarkably ridiculously slow. We've had experiences with that. So avoid, the big name auditors. They are wonderful in the right place. For giant companies, they can afford the expense and they love the blessing of having one of the big auditors on their books, as it were, as a provider of that service. But for the scale of the size of companies that do Reg A pluses, the risk is too expensive and the risk of ridiculous delay is terrible. Set a low minimum escrow amount if you can. If you're buying an asset, you've got to set the minimum to be what money you have to raise to buy the asset. But if you're growing your business and you write your Reg A plus properly for that, then you can set a zero escrow minimum. That is to say, we'll raise money and we'll weekly, whenever we choose to, we'll do escrow closes and issue the share certificates to the investors. And set a high maximum raise because that gives you flexibility where you aren't limited later. If you start out planning to raise $18 million and then there's some good things happen and you make an acquisition and now you want to step up the raise size, not having to go back and requalify a larger raise amount is a luxury, right? So why give yourself that built-in limit, that limitation? Use a low per investor minimum because when we're marketing to investors, I say when our customers are marketing to potential investors through advertising outreach and so forth, somebody's doing something else and they see an ad and they like it enough that they click on it and then they arrive on the offering page. And if they like it enough and understand it enough and it's pleasing to them, then they may invest. But at the moment, it's a very casual thing. So if you give them a $2,000 investment minimum, most people will just leave and never come back. I mean, I've seen higher. I've seen $5,000 investment minimums, which are the kiss of death in a retail Reg A plus. If you're only bringing in accredited investors, then why would you do it in a Reg A plus? You may as well do a Reg D offering. But that's important because at that point in time, it's a casual engagement. Now, they may invest a modest amount initially, but then they're on the email list for updates and they're visiting the offering page, and you're conveying updates to them and making it more and more interesting and building credibility through the success of the raise. Then people will come back and invest more, and then sometimes they'll come back with their managed IRA and invest a lot more. But we would have lost them at the beginning if there was a $2,000 minimum, for example. I mentioned this earlier, but you can change the valuation and the share price of your company during a Reg A plus, which is a lovely thing because you can reward the earlier investors who took a bigger risk because at the beginning it was more risky than it is at the end of a large raise or even a small raise, right? So you're rewarding them for being risk takers. But when you make a modest share price increase and announce it in the proper manner and the right to the right audience, which is regulated by the SEC, then you're reflecting the fact that people could have taken a risk earlier and chose not to, and you create genuine, legitimate rarity value by telling people that on Thursday at midnight the share price is changing. If you do it in the right manner, the right language, then that can be very helpful to nudge people from spectating into actually investing. A couple more tips. FINRA, the regulator for broker dealers, is very slow. So bear that in mind when you're making your plans. You don't have to use a broker dealer, but if you do use one, then you are dealing with FINRA. So getting all the ducks in a row filed very, very early is a valuable thing because of that. And of course, marketing is key. It's all about marketing communication of one kind or another. So that concludes my formal prepared remarks. So I'm now going to look to the Q&A and do my best to answer questions here. Thanks very much for your attention, guys. I'm going to go to the list. I'm going to start at the top of the list of questions. Please feel free to add more questions now. Yeah, I don't have any comments on Bob Marley. That would consume time in an unprofitable manner. Comparing a Reg A plus to a SPAC, it's completely different. I mean, a SPAC is essentially an acquisition where you get in touch with a company that has done a SPAC IPO and is ready to buy a target company. And if they like your company, then it's a sizable buyout. So that's like dating. You don't know until you meet the right partner. If you've met the right partner, it may never happen or it might take 10 years. Reg A Plus, you have control over it, which isn't to say you have control over everything happening in a smooth and delightful, successful, inexpensive manner, of course, but at least you have control over doing it, implementing it, running, and how you set it up. So it's much more flexible in that way. And do Reg A Plus IPOs have the same disreputable reputation as SPAC IPOs? Well, no. SPACs were hot for a while, right? But you can imagine it's a different thing. A SPAC thing is a very different situation. So Reg A Plus, I would say in 2017, when the first Reg A Plus IPOs took place, some of them underperformed in the aftermarket. And there was quite a lot of criticism of some of those companies. Some of it was valid, some of it was not. But over time, the reputation of Reg A Plus and companies conducting Reg A Plus offerings has grown, and it's become more accepted and credible and much more broadly used. Yes, there's no shorting on an ATS and no naked shorting, both. Well, of course, if you can't short, then you can't naked short. But yes, that was what I was saying. And Jose says an LLC cannot do an IPO. C Corps can actually, an LLC can do an IPO, Jose. But I'm not going to dwell on that, but that's the case. How big does a Reg A Plus candidate company have to be? It's not about the size so much as it is about how, of course, in some companies' case, it matters how big you are, because if it's in a relatively boring business area, then it needs to have dynamic numbers about it, and it still needs to be very appealing. But at the end of the day, the SEC doesn't qualify a company or not qualify a company because of how big it is. They're not saying, oh no, you're not old enough. Oh no, you don't have 360 employees, so we won't entertain this. It's the investors. Do the investors like the offering enough to want to participate? That's the question. And the investors are motivated by How big is the upside? Do I like this? What the company is doing? Is it engaging? Is it motivating to me? Is it well explained? So that is more important than how big is the company. Yeah. So the scale of the market you're dealing with, if people can easily understand the business, if they can easily be, if the advertising can be visually appealing. I mean, there are biotech companies that I've recommended do something else who were making products that were valuable and useful, but absolutely abhorrent to think about. And a picture, you can't conjure up a picture that anyone wants to see in an advertisement, and text ads don't work very well. So, it's got to be something, if it's engaging, if you're addressing a big market, if it's exciting, and if it's well marketed, then it can be a startup company. Quite a few successful Reg A pluses have been new companies. Some of them had long-term planning behind them and then launched. And obviously, there are some well-established companies. We have a company called Cub Crafters is with us on our platform raising money for their Reg A plus, and they've been in existence for 42 years. It's a really neat company, and they have a great brand and awareness and so forth. But if I've answered that question now, I will go on down the list. How and what social media do we see working? Usually, Facebook and Instagram are the most effective in general terms, and you might not want to hear this or you might be skeptical, but TikTok shows promise. They're a bit too disorganized, but their AI targeting algorithms are astoundingly great. So we've had some of our customers do test marketing on TikTok with very good success. I have three businesses in three locations. I'd like to expand, but I don't want to give up rights to my initial three. I'd like to include in the option to purchase location to include in the option to purchase locations as well as opening a fourth location. Yes, well, that's something you can do in a Reg A plus. Does the SEC regulate the price of Reg A plus shares? They don't. They don't judge the merits of the offering. They're not going to tell you, oh no, that's overvalued. They're not going to say, a $68 share price is too high, which I think it is, but they're not going to tell you that. They aren't judging how appealing the investment is. They're making sure it's legal. They're making sure that you're following all the rules and you're adhering to their system very carefully and delivering on all their requirements. They aren't second guessing whether or not this is going to be a great investment for someone. If you have 1,000 subscribers in an LLC, is the LLC considered a one shareholder in a private company, or is each shareholder? That's a longer question. You can use an LLC as a feeder into another company, so 1,000 investors are treated as one by that company. But that takes more discussion to explain. Um, you don't need it in a Reg A plus, but um, technically, what you're describing is true. And make sure I'm seeing the second part of it. Yeah, so if it's done properly, that LLC entity can be one investor in the entity that it invested, as long as it's done in the right manner. But that's a longer discussion. Can we offer product discounts? Oh yeah, can you offer product discounts or incentives to sweeten the deal? Yes, I'll explain that. And how common are product discounts or incentives? So they're reasonably common. So you can do it in two ways. One way is, hey, you just bought a product on my website and you spent $500. Here's $50 off your share purchase, as long as it's prepared and put and included in the Reg A plus. So now you've got somebody feeling motivated to consider investing. You put a clickable link in there. You could do it the other way around, where they are buying an investment and you give them an incentive to do so. So if you invest more than $5,000, we'll give you 10% off our electric car, or you'll get a $8 price per share. Price per share can't change, but you can give free stock to people, right? So you can say, for investing $10,000, we'll give you a 10% bonus shares for your investment. The share price is always fixed, but you can give bonus shares for a larger investment. That's another way to go. Or you can give services and lunch lunch with the CEO or lunch with the spokesperson, things of that type too. My thoughts about using a safe in a Reg A plus. I don't think you can do that. I don't believe the SEC would allow that because it's an offering of a security. It's not a potential offering in the future. So a SAFE is a convertible loan, really, where investors lend money to a company, and later on they'll find out what the share price is and what the terms are. You can't do that in a Reg A plus. And it would, yeah, I don't like safes because I don't like the uncertainty of what the terms will be later. If I'm putting money now into a company where it may raise venture money 4 years from now, I don't want that venture round determining what price I paid 4 years earlier. I'm taking a big risk in the earlier stages in that case. Okay, so I'm at the end of the questions. And if you have more questions, post them now. Otherwise, I'll move to start wrapping up the meeting. I hope that you guys have already found this to be a useful webinar. While you're thinking of a question, if you are, I'll conclude on a couple of points. You've seen the disclaimers. We're not attorneys. We're not valuation professionals, auditors, underwriters, or professional valuation companies, if I didn't already say that. So I'm giving you the best guidance I can about what works and how things work. But if you need a securities attorney, I'll find you one, but I'm not the one. Then we have made a recording of this webinar, and we will be making a blog post with the recording, and we'll be sharing that to you and to the other people who booked to attend but didn't. And it'll be published on the MSC website with a clickable index, so you can just look at the parts of the webinar you're interested in. You don't want to watch the whole thing twice, right? It would be a bit too slow. Okay, I'll see what questions there are. Oh, thank you, guys. Yes, Steve, that we're making a recording. A public company can use Reg A Plus to do a secondary offering, yes. And actually, one of the nice things about Reg A Plus that I didn't mention yet is that you can use it to do a direct listing to the NASDAQ or the NYSE. So you wouldn't use an underwriter, and you save a lot of money in that way. That's something we know how to do, and we can help you with. And I've got a couple. Thank you very much, guys, for posting your thank yous. I really appreciate that. And Alan Stone, should one already have done a CF funding? No, you aren't required to do a CF before you do a Reg A plus. If you're ready and willing and able to do a Reg A plus, um, then you can do so. And you can do a Reg D in parallel with a Reg A plus if you choose to. You have to update the cap table from time to time. And the question Alan asks is, what's the difference between Reg A and Reg A plus? Reg A to Reg A plus was a very big step. The maximum you could raise in the old Reg A until Reg A plus was maybe $500,000, $300,000, and you had to go to the states one by one and file and get permission to raise money in those states. Reg A plus tier two gives you exemption from having to ask permission of the states. You have to file with them and pay them a fee, which is not an excessive fee, but you don't have to go and ask them permission in the main. There are a couple of states that don't cooperate. But Reg A Plus Tier 2 is a walk in the park, both because it goes up to 75 million and because you get a much smoother journey with the state filings. Tier 1 is a bit more like the old Reg A, where you have to go to each state cap in hand and request permission to raise money in that state, and that isn't a long, slow journey unless you happen to be so powerful in one or two states that you could raise money in just those. Canadian companies Canadian companies can do a Reg A plus. I don't know if they can do a Reg CF. I'm not familiar with that because we don't do Reg CF through choice. Is putting together a stock option plan for third parties something that is subject to securities laws if the stock is restricted? Yes. You don't have to do a Reg A plus filing to do that. But the rules around the IRS is the most heavily involved regulator involved with stock options in private companies. But there are aspects of that that get into SEC regulations as well. And you do need audited financials in a Reg A plus. Yeah, in a public company, then yes, you're dealing with stock options, the SEC has strong views about that stuff. But Reg A plus financials audited, yes, in a tier two. One of the only reasons people do tier one Reg A plus is because you don't have to have audited financials. But in a tier two, you do. And if the company has existed 2 years or more, then you need 2 years of US GAAP audited financials. But if you started it 6 months ago, then you need audited financials for those 6 months. Okay, so thank you very much, everybody, for joining us. Thank you to Akash, who's been patiently helping administrate this meeting. And thanks to Peter, who's not with us on the call, for doing the marketing and promotion and invitations and so forth. I hope this has been useful for you. We'll be, as I said, in about a week, we'll send out the recording with a clickable index to it so you can refer back. And look forward to seeing you. And if you need help with your Reg A Plus, come and see us. You're welcome to email us. In fact, I'll put my email in the chat box right now. I should have done that earlier. You're welcome to email me for guidance and joining up with us to have us help you optimize your offering. That's what we do. Again, thanks everyone. Have a great day. I'm glad you joined us and I hope you are too. Thanks. Bye-bye.